Hi everyone, we're ready to get started now. So I want to welcome you to this webinar, Inside the Insights with Mercatus. I'm your co-host, Madeline Milani, Marketing Manager here, and with me is Sahas Singh, our Analytics and Insight Lead here at Mercatus.
Thanks, Madeline, and thank you to everyone who is joining us today. We're excited to share with you our findings from the latest version of Mercatus's Energy Insights report, which Madeline and I co-authored earlier this year. Over the course of the next 30 minutes, we're going to walk you through what we think were some of this year's most interesting insights.
Yes, and please feel free to tweet us your questions or submit them via the chat box, which you can find at the bottom of the GoTo training panel. We'll get to as many of them as we can at the end, and we're also happy to follow up with you individually with any questions that we can't answer today. So before we get started, I'll give you a brief introduction to Mercatus. Born in the heart of Silicon Valley, Mercatus started almost 10 years ago as a consulting firm for US solar developers. And since then, we've grown into an enterprise software company providing software solutions for alternative asset developers, owners, and investors alike. Our customers are some of the largest energy producers and investment managers in the world. Collectively, we manage over $450 billion worth of asset investments in our platform. Today, this includes over 209 gigawatts of assets in more than 100 countries across 10 different technologies, spanning from energy generation to storage, efficiency, and now electric vehicles. As we've continued to grow our global customer base, the analysis of global project data inspired us to start reporting on what we're seeing, which has taken the form of our annual Mercatus Trend Report. So now, in our 6th edition, this report contains analysis of real project data from those 209 gigawatts of global assets and highlights historical trends and makes future forecasts for the growth of renewables. In the report, we measure changes in offtake rates, installed cost, regional growth trends, and more, which you can find in the full report. And if you haven't gotten a copy, you can find it available for free on our website, or I'll be happy to send you one. Just shoot me an email. But for the purpose of this webinar, we've narrowed it down to just 3 key findings, which we think are really interesting. I'll take you through those right now. The first is around financial modeling insights and best practices. As asset portfolios continue to grow and diversify, we observe new trends in both consolidation and growing complexity in how project financial models are managed. Next, we'll look at how Trump's import tariffs could impact the US solar market in terms of investor attractiveness. This is an important case study highlighting the importance of performance scenario-based analysis when it comes to hedging against political and macroeconomic risks. And finally, looking forward to our future predictions, our forecasts show that in the next few years, the average alternative asset fund or portfolio will comprise of 5 or more technologies across 5 or more regions by 2021. So let's get started now with financial modeling insights. New to this year's version of the report, we've dedicated a section to financial modeling with our analysis of performance modeling techniques and recommended best practices. Through the aggregated analysis of over 10,000 global projects in both development and operation, these are the new trends that we're seeing in financing, forecasting, and risk modeling today. So now I'll turn it over to Sahas, but first I have a question. Why the focus on financial models now? Because this is something that we haven't reported on before.
That's a great question, Madeline. And today, investors are really demanding more certainty and transparency from their alternative asset portfolios, which really gives rise to a need for more nuanced and complex financial analysis. Hence, investment teams are turning to larger, more detailed financial models to manage the underlying risk associated with their portfolios. Whether it's combining multiple asset classes into one investment, forecasting multiple scenarios, or incorporating nuanced local tax and incentive-based financing structures, investors and asset owners really now demand more granular forward-looking analysis. Hence, the underlying trend here is that an increasing level of sophistication and complexity mean that asset managers are beginning to rely on complex financial models to assess and measure the profitability, risk, and performance of their funds.
So great. This next chart, shows that IRRs deviate from the benchmark mean as the number of inputs or assumptions in a financial model increases. But what does this really mean for business developers and asset investors?
Well, I think what this shows us is that investors in Mercatus are using smaller, more consolidated models to evaluate and qualify the vast pool of business opportunities at the early stages of the investment lifecycle.
Right, so that speaks to a need for centralized, simple, easy to update financial models. It sounds like business developers and investment teams should really utilize these in the qualification stages of a deal.
That's precisely right, Madeline. However, as deals progress through the investment lifecycle, it is important to note that investment teams are continuing to add that nuance and complexity to their models. And that's really helping to hone in on the cream of opportunities that are out there. The business developers really need the ability to cherry pick the projects which offer those returns with the abnormal alphas that we've talked about.
And that's why we see a pronounced deviation in IRR from the benchmark mean as financial models inputs increase.
That's absolutely right. As the number of inputs to a financial model increase and more complexity is added to those models, projects start to differentiate themselves from the market benchmark or average as either very good projects or perhaps ones that might need to be left by.
I see. So what are the top takeaways that investment managers should heed from these three examples?
Well, I think there are two main takeaways. The first one being that business developers need access to a centralized financial model, one that is quick and easy to update. That's really the only way organizations will be able to effectively sift through the plethora of business opportunities that are out there. The second, however, is that once a deal actually progresses to the latter stages of the investment lifecycle, investors need the ability to seamlessly add regional and asset-specific nuance to their models to, again, differentiate those good investments from the stellar ones. At the end of the day, the devil really is in the detail, Madeline.
I couldn't agree more. So moving on to our next section, looking at the impact of the Trump tariffs on the US solar market. So earlier in 2018, the ITC Section 201 trade case decision went into effect, allowing the president to tax imported solar panels. Trump's implementation of the ITC proposal was less severe than originally expected, resulting in a 30% tariff that'll phase out over the course of 4 years. So out of curiosity, we did an analysis on how these tariffs would impact returns for utility scale solar projects, so those 50 megawatts and greater, in the United States. And what we found was alarming. The US, in our worst case scenario, would fall from 9th to 19th place in terms of market attractiveness. Sahas, can you explain how this could happen?
Absolutely. So in our analysis, we found that the US was actually expected to fall from its global ranking as an attractive solar market quite steeply, with pre-tariff IRRs, or internal rates of return, originally around 8.7%, dropping to under 6.5% with the introduction of those White House tariffs. Of course, rising import tariffs did project to cause install costs to drastically increase for those large projects, especially since those modules and cells do make up a significant share of install costs. A worst case scenario analysis actually showed us that an increase in imported module prices would have an adverse effect on project finance across the country, causing a 214 basis point drop in IRR. It was also interesting to note, I think, that this caused a number of projects to be pushed into a negative NPV, or net present value, for a lot of projects that were due to come online after 2018, which was, had the adverse effect of pushing those projects out of the realm of financial viability, which is obviously a scary thought. That being said, it was important to note that a number of large US solar developers did, show some foresight and did see this coming. They did stock up on those foreign power panels before the tariffs went into effect. But if they hadn't done so, I think the outcome of these tariffs could have been so much more severe. But thankfully, this seems to be a little bit more of a minor setback to the industry.
Yeah, and let's hope so. I think that this is an interesting case study because it teaches really two important lessons. The first is that it's essential for investors and project developers to be able to aggregate and store their project data in a centralized system so that they can better facilitate the projection of the outcomes of scenarios such as this one with the tariffs.
And that's completely right, because I mean, especially in today's current economic and political climate, analysts really need the flexibility to adjust those macro market influencing levers, which of course hold so much sway on project returns across the globe.
Yeah, and speaking of the global market, that transitions perfectly into our third and final section, our forward-looking predictions, looking into 2020 and beyond. I think if we had to characterize the energy section, the energy sector with a single word, that word would be diversification. Because in the next few years leading up to 2021, we'll begin to see asset owners diversify across both regions and asset classes. So let's start with assets. Sahas, what are the growth trends that we're seeing in the next few years?
Well, if we look out to kind of all the new projects that are planned by asset class through till 2021, solar does continue to take up a large portion of the capacity due to come online. But what's interesting is that we're seeing increasing shares in wind, hydro, biomass, energy storage, and even EV charging that are taking on the market share, especially in terms of the data we're seeing coming through our platform.
That's interesting because solar has been so prolific in the last 10, 15 years and still is growing. So why would it be slowing down in the next few years?
Well, it's an interesting question, I think, Madeline, and there's probably a number of answers there. The first that comes to mind is probably the expiration of the ITC, that is the investment tax credit, of course. As government incentives ramp down, asset owners are actually looking to diversify into a number of other asset classes. However, I think if you ask my personal opinion, I don't think the trend is driven so much by solar slowing down, more so than a growing interest in those alternative asset classes, which offer much more diverse risk profiles. We predict that this trend actually will really take into effect during the latter portion of this decade, where investment managers are looking to spread their investments in not only technologies, but also risk profiles.
Yes, and I think it's definitely an interesting time to be in the renewables business, especially in the United States, with both the aforementioned import tariffs and, of course, the expiration of the ITC, which feels oddly so close now. Which foreign markets then are showing the most growth potential in the coming years?
Oh, well, Madeline, I think the story today is really all about emerging markets. I was in India recently talking to a couple of our infrastructure asset developer partners, whom today are prime targets for foreign LPs and institutional investors. The challenge, however, is really where asset managers need to prove to foreign investors, especially in those emerging markets, that the promise of steady, low-risk future cash flows from alternative asset classes really deserves that confidence from financiers in the form of low-cost capital. Looking forward, I think we can expect to see growth in these regions, and especially a number of specific asset classes. But what I find to be most interesting is that by 2020, most asset owners and investors will actually operate funds that hold 5 or more asset classes and are present in 5 or more world regions as well.
That is huge to me, because in the last 4 years that we've been writing this report, and I can't believe it's already been 4 years, we've yet to see such diversity before. So what I take away from this is that owners and investors now face a really complex challenge ahead of them, which is being able to construct and manage funds with the diverse risk profiles that the LPs are now demanding. And further, as asset owners move into emerging markets, they're going to need a meticulous reporting practice in order to mitigate against the high cost of capital that we're seeing, and to be able to avoid costly compliance violation errors. Those to me are greater than ever. So coming to our final thoughts, our data mirrors other industry analysis that all clearly show challenges ahead for asset owners and investment managers. And we've seen the following. that shrinking profit margins are indeed affecting profitability. Risk is still a growing concern, spurring more diversification of assets. And new growth is challenged by inefficiencies in operations and asset modeling. But looking on the positive side, alternative assets show some of the biggest investment opportunities, with projections to reach $15.3 trillion by 2020, according to PricewaterhouseCoopers. 50% of that growth will be in energy and power, and the other 30% will be in infrastructure and real estate. So the opportunity is right for both profitability and for accelerating the sustainability of our planet. The key, I think, is having the right technology infrastructure to manage and control increasingly complex data volumes and financial models to enable accurate and predictive insights on performance and risk. And at Mercatus, we're always happy to chat about your challenges and priorities to see if our platform could add value to your investment process. Please feel free to reach out to Sahas or I with any inquiries. Our emails are on the slide, and for more information, you can visit our website, www.gomercatus.com. So now, with about 10 minutes left, I think we should open it up to questions. And we did get a couple questions this morning, so I'll come to the first one. Here we go. So this is from an asset financier in Maryland. I'm curious if you can share stories from any of your clients regarding best practices on financial model control and how they've been able to improve margins. Sahas.
Definitely. What we've experienced in terms of working with our customer partners is a growing focus on digitalization really across the entire life cycle of an asset, which means more centralized control of data inputs and financial models for better investment decision making. In fact, we've seen as much as 5x in terms of productivity gains from more efficient operations and use of data. Of course, also a lower overhead does mean an ability to price deals and to actually qualify deals more aggressively, which always is an active target or goal for a number of our customer partners who are kind of wading through the sea of business opportunity that's available in the market around the world.
Yeah, there certainly are a lot out there. All right. Coming to our next question. You talked in the trade case section about being able to anticipate the impact of scenarios like potential tariffs. So how does this work?
Well, I think at Mercatus, we're really unique in our ability to enable forward-looking analysis. Our platform allows analysts to seamlessly update scenarios and sensitivities, which it really kind of enables analysts to kind of project future outcomes based on different levers that they could pull in terms of kind of global macroeconomic inputs. And then, of course, we're able to actually visualize those scenario outputs with our business intelligence suite, which gives executives a really kind of interesting and at your fingertips almost overview of the state of their business.
Yeah, I think that's really crucial in terms of today with, political instability in some regions and whatnot. So being able to do that is really important. Okay, we do have another question here. This is from a developer in California. A lot of our asset and investment data is scattered in emails, PowerPoint, Excel, spreadsheets. How do you help companies consolidate those data elements for centralized control, even as inputs are constantly changing?
That's a great question. So again, I think our proprietary technology does a fantastic job of hosting project financial and operational data in one place. And then what that effectively allows for is a seamless access to that data, not just for data aggregation purposes, but also for the purpose of analysis, automating the generation of reports, building live dashboards, all kind of solutions that help, I think, alleviate some of the challenges that we're seeing in the industry today.
Excellent. Okay, another question in from the audience. Are the IRRs that you talk about in the presentation in USD, or are they in local currencies?
That's a great question. So in order to kind of perform this analysis on IRRs around the world, what we did actually have to do was normalize them. So we did normalize them across different countries, different regions, from obviously different currencies back to US dollars. And then we did also normalize them for after tax, or sorry, I beg my pardon, before tax IRRs as well. So that's kind of how we managed to aggregate those returns across a range of different projects.
Great, thanks for clarifying. And that's all the questions that we have today. If you have any more, please feel free to email us. After we finish recording this webinar, we'll send everyone off a recording so you can see the slides and the audio. Thanks everyone for joining us. We really appreciate it.